All right, we'll pick it up with part 4 of this first homework set here. All right, so this one is just asking a very straightforward question. I give you revenues during the period, 2,750,000. Expenses are 1.6 million. So if that's true, what's your net income? So again, just take the difference here. Always revenues minus expenses. So our revenues of 2,750,000 minus our 1.6 in expenses will yield a net income of 1,150,000. If I had transposed those two elements, instead I said the revenues are 1.6 and the expenses were 2,750,000, we'd have gotten a negative 1,150,000, and that would have been expressed as what? A net loss. So again, if you had a negative number there, net loss, positive number, net income. So that's very straightforward. Right, so I asked you for part B to take this information and basically incorporate it into what give me the ending retained earnings balance based upon some additional information. So if beginning retained earnings starts at 5.4 million, and this is what dividends declared and paid during the period were, what's going to be your ending retained earnings balance? All right, so we'll start with the 5.4, because it always starts there, beginning retained earnings. And again, it'll be plus the net income minus the dividend. So what I did here is I just took those two numbers, again, that's just the net income that we had in part A, and just net them against one another. In other words, the change in retained earnings for the period is it went up 685,000. So add that positive 685 to the beginning balance of 4.4 million, 5.4 million, excuse me, and we'll get 6,085,000 as ending retained earnings. So again, nothing more to that one. That was one of the more straightforward parts of the homework that you'll observe, and that's not just true of this one, but maybe for the class in general. So again, let's go on to part 5 here in just a moment. Now for part 5, what we're going to do here is we're going to tackle the idea of reversibility in accounting. In other words, like I've been giving you, like part 3 of this homework set was what? Here's a verbal description, now give me something in accounting equation format. Okay, so that was what I was asking for there. Now here, I'm giving you the accounting equation form of the transaction. Again, a little clumsy. Again, will be rectified sooner than you can believe here. We'll change to something else, to a different rule. But same idea should apply here. In other words, I can reverse that. If I give you accounting equation form, now give me a verbal description of this. Again, there's not necessarily only one way to describe this. There's some other, so if you're doing this on, you're doing homework and you say, okay, I came up with a description that doesn't match exactly what I have, that's fine. As long as whatever you described, I would take that description and I would end up doing the same transaction as you observe in this format. As long as that happens, then your description is adequate. But there's some rules that you should follow when you're doing descriptions, and one of those is to try and start with a verb form. I'll get that right here in a moment. A little tired as I'm doing this. I will be fully, I'll be fully honest about that. This is kind of a hectic period right now for me. So, anyways, to continue with the matter at hand. So that's all I want you to do is just give me a description that fits what I'm giving you in accounting equation form. So I start out with cash going up 1.5 million, accounts receivable going down by 1.5 million. So implicitly, there's an equal sign happening over here because these are both asset accounts. Right, so we have two asset accounts. So something's happening on the same side of the accounting equation. It's fine because why? It all balances, right? One went up, one went down by the same amount. It's a big goose egg as far as the impact on liabilities and owner's equity. So we're just reshuffling what happened to our assets. So what's an adequate description of what happened here? All right, so again, good place to start is collected cash from a customer or customers. Again, I didn't tell you how many it was. It could be one, could be many, whatever. That's why I left you vague. And again, on account or on credit, you have to put one of those in there. So collected cash from customers on account or on credit, and then the amount is 1.5 million. And every element you're looking at in there is necessary, right? So if you just say you collected cash from customers 1.5 million, that makes it sound like it's what? A new revenue. You just provided services and now you're recognizing revenue at the same time you're collecting cash. That's a different transaction. So you must have the element of on account or on credit in there in order to give me the full description. Absent that element, again, it's incomplete. I would take that and give you a different answer. In other words, it would be cash going up 1.5 million, fees earned going up the same. Not the same as what we have here. This is just previously recognized revenues now our customers are making good on their promise in the form of the account receivable. All right, so that was for this one here. So for the second one, again, I didn't number these, I just kind of gave them as just here's an example and just give me a description. Automobiles went up 475,000, accounts payable by a corresponding amount, 475. So again, in this case, our equal sign implied here is like that, because we have something happening on the asset side, something happening on the liability owner's equity side. So again, what's a good way to describe this? So what's the primary action here? Purchased something. What? Automobiles. How did we buy them? We bought them on account or on credit, $475,000. So again, you have to have one of those two phrases there before the 475, or it's a different answer. If you just said purchase automobiles 475, how would I interpret that? Automobiles went up, cash went down 475. See, it's a totally different animal we're describing here. That's why, again, that phrase on account or on credit is very, very important, because it paints the whole picture here. All right, so what's up next? Accounts receivable increased 860, fees earned by the same amount, 860. So here, again, this is one way to describe it. I said, well, we billed customers. So if I see that you billed somebody, that tells me, oh, a bill equals what? They haven't paid yet. Therefore, it's reasonable to assume that that amount will end up where? In a receivable, or accounts receivable specifically, because that's how you would reflect that. Likewise, you could have said what? Completed jobs for customers on account or on credit, 860. That would also be an adequate answer, and I would end up, taking that verbal description, and that's how I would do it in the accounting equation form. Plus 860 to AR, plus 860 to fees earned. So again, there's some latitude in how you can describe this, not just one way. Right now, this one sometimes is a little tricky for people. So we have accounts payable going up by 4,500, and utilities expense, again, that negative 4,500 is its impact on retained earnings. It negatively impacts retained earnings by 4,500. So what would be a good way to describe this? Well, again, obviously you're recognizing what? You're recognizing an expense because it's been incurred. But yet, what's the problem here? Well, it's not due yet, right? That's why you're dumping it in a payable in the meanwhile. So it reflects, like, what do we, business was conducted in the current period. Therefore, it's correct to reflect it as an expense in this period. So that's the first portion that we're tackling here. That's what they're showing you here. But the second half is saying, well, we haven't paid it yet because why? So I thought the best way to express this is, like, how would that look in reality? Like, what would it look like if you had incurred utilities expense but just hadn't paid it yet? And why haven't you paid it yet? And the answer is what? Utilities expense were billed for the current period, right? You've got a bill, but they're not due until next month. 4,500. So that's a fair reflection, right? It's an expense now, but it's not due until the next period because it wasn't due until the next period. Right? The bill says, due, like if we're talking about the month of June, which is when I'm doing that. So let's say you get utility bills in the month of June for utilities that you used in June, but it says it's not due until July 4th or July 5th, whatever the case may be. And then, so you'd say, oh, well, we have to reflect it now because why? Because it impacted this period, current period, June, but isn't due until the next period. So therefore, the reality is that's a payable that we're talking about. Right, here's another example of a compound entry because we have three elements at work here. So again, what's happened here? So you see cash went down 350, land went up 950, and accounts payable, not necessarily realistically that we're talking about here, but again, went up 600,000. More realistic would probably be something like mortgages payable was in fact not accounts payable. So what's the primary thing that happened here? Well, obviously what? We purchased land for how much? 950. And how did we pay for it? We paid 950 in cash, and I could just simplify the rest by saying the balance is on accounts or on credit. In other words, take 950 minus 350 and you'll get what? The liability portion, it has to be 600,000. Regardless of how we label it. If we label it accounts payable or notes payable, whatever the case may be, the liability portion is the difference there. Lastly, another compound entry. So in this case, we have cash went up by 745, equipment by 175, and capital stock, which means the same thing as common stock. Those are interchangeable. So it's a good way to verbalize that one. So again, sold what? Shares of stock. Receiving, or I could have even more refined saying in exchange for $745 in cash and equipment, and this is important, with a fair market value of $175,000. Again, where did that number come from? That was a fair market value evaluation that led to that. So again, what's the rule you should always abide? And you could try this maybe if you grouped with some people in the class. You know, everything's online as of the making of this this video. So if you've decided to partner up with somebody, test each other, give each other your answers in verbal form, like I'm showing you here, and then ask them, okay, if I gave you this verbal description, what would you like? How would you do that transaction in accounting equation format? What would it look like? And if they give you whatever you're observing here as my source data, then that would be okay, your description's adequate. If they ended up answering something different, then that means there's something missing, or there's something you have either included you shouldn't have, or excluded that should have been included. It's a variety of those can be applicable. All right, so there's just one final portion here to the homework, which we'll get to in just a moment. And last but not least, here's part 6, which it's just simply, it's a little bit of a soft issue, and also it's a bit of a foretelling of what you're going to see in some future material. So that's the other purpose here. So just phrase it as a simple question here. Questions. If corporations paid in advance for services to be rendered in the future, should the receipt of cash be recognized as revenue? All right, so we'll just start with that one. All right, so that's number 1. So the answer to that one should be a big no, right? No to that one. Why? When do we recognize revenue? And what's the standard that we've already put forth? Recognize revenue when it's earned. So if somebody simply gives you money, you haven't earned it yet, so it definitely can't be called revenue. Now, what if you pay for services in advance? Should you recognize that as an expense? And of course, the answer to this one would also be no. How do we end up recognizing expenses? What's the trigger for recognizing expense? And that is if it's been incurred. Have you used goods and services? The answer is no. Obviously, that's not true. If you just simply paid for something before you'd actually received it, it's the same idea. If you get money in advance for services you haven't rendered, that's not revenue, so you render them. Likewise, if you pay for services in advance that have yet to be rendered to you, is that an expense? The answer is no. Not until the company that you've paid in advance has had a chance to render that service. Then it becomes an expense because you've incurred it. That's why the answer here says neither of these qualifies as revenue or expense. And again, just to go over it again, how are you going to handle that? Like, in other words, in the first one, you have more cash, right? Cash went up by, let's say, $1,000, just give a verbal example. What's the offset? The offset should be to a liability. And again, we're going to give you a specialized name for that liability in a further handout / video, so don't worry about it right now. So that's the reality. Because if you never provide the service, what would you have to do with that money? Pay it back, right? That's the reality there. If you never provide the service, you would have to pay that back to the customer because you didn't do anything for them. So that's the reality. So you technically owe that money. Therefore, that's how you should observe it in your bookkeeping as a liability at this point. Now, as for the cash payment, so this is paying for services that have yet to be rendered to you, we're going to book that as an asset. In this case, specifically, we'll call that some sort of a prepaid. Like if you pay for insurance in advance, we'll call that prepaid insurance, rent in advance, prepaid rent, and so on. And again, what's the reality here? Again, only after a corporation provides services to the customer or uses up the service they had paid for can they recognize revenue or expense. So that's always going to be a trigger. Have you earned the amount in question? Yes, then you can call it revenue. Have you incurred the amount in question? Yes, then you can call it an expense. And so again, that idea will be elaborated further in future videos / handouts dealing with this topic at hand. All right, so that concludes all of the videos for the first homework set. So look forward to future homework sets from here on out. Of course, obviously, the next one up will be number 2. So I'll see you there.